We have even more conviction in the need to be defensive at the moment, so I understand a bit the fact that risk assets today and in the coming days may remain under pressure.
One way for the governments and the central banks to go is to focus more on production. How do you get more things out in the economy? And that makes it it means that you won't have to do as many rate hikes.
While we will do our best to control the epidemic, we aim to have the maximum connection with the international world, and also to reduce the inconvenience to people who arrive at Hong Kong.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York, looking at UNGA with the first trip of Liz Truss. Here's what's coming up on today's program. Go big or go home. Global central banks line up jumbo hikes. The Riksbank surprises with a 100 basis point rate increase. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a three-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. Now, we have quite a lot going on, of course, here in the UNGA. This is General Assembly, where we have heads of state starting to arrive either late last night or this morning. We'll follow especially what Liz Truss will do on her first real working week after the morning of Queen Elizabeth II. European stocks actually following peers in Asia higher after an 11th hour rebound on Wall Street. That seems to indicate that traders are really coming to terms with another jumbo Fed hike, but had priced out expectations for a bigger surprise. The dollar pretty much little changed. In terms of what we're seeing overall, a look out for currencies, the U.S. Central Bank does kick off its meeting today. It's expected once again to hike rates by 75 basis points on Wednesday. Signal rates, of course, are heading above 4%, and then it will pause. If we have something different, we could see a big change on where the markets price in further hikes. In terms of what we're seeing in Europe, again, the big one to watch out for is Italy. They have elections on Sunday. No matter who wins, and we think it's a center-right coalition, we'll have questions about the budget, and we'll have questions on what and how BTPs take it. So it is a big week, as you know, for global monetary policy. Central banks around the world are forecast to deliver rate hikes, adding up to more than 500 basis points combined, with the potential for an ever bigger tally. Well, Sweden's Riksbank kicked off things earlier this morning. The U.S. will follow tomorrow. We're joined by Miles Bradshaw, head of global aggregate bonds at JP Morgan Asset Management. Miles, thank you so much for joining us. We're also joined by Christina Keene, of course, our MLive editor. So, Miles, thank you for joining us. Where is the smart money going this morning?
I think the smart money is really to anticipate central banks to be more hawkish. We've seen it from the Riksbank today. We've had a story of inflation being too persistent. We've had a story, despite slower economic growth, the labour market being very strong. You know, if you saw the decline in jobless claims in the US last week, central banks know rates aren't in the right place. The question is, why delay getting there faster? So I think the smart money is to bet on them being more hawkish than markets expect. Wouldn't be surprised if the Fed were to raise rates 100 basis points tomorrow. Yeah,
so Christine, first of all, do you agree with that? And we've seen, of course, a move in Treasury two-year yield. Where do they end up?
Absolutely, Francine. I think, you know, as Miles was saying, the smart money really recognizes that the central banks need to do more to curtail this rising inflation, even at the expense of potential growth slowdown down the line. And, you know, when it comes to that two-year yield in the U.S., I mean, I think we're looking at pretty much toward the 4% level at this rate, which is quite astounding, because just a few months ago, 3% seemed to be the ceiling. But, you know, it only took a few months to change that story. But I think more broadly as well, where those yields end up and where market pricing ends up really will depend a lot on where markets gauge the terminal rate to be. At the moment, I think markets are pricing for that to be at 4.5% at the first quarter of 2023, and then quite a sharp pullback from that level by about 100 basis points over the next year after that.
So, Miles, if we get 100 basis points, what happens to the markets? It's not priced in. I know in certain parts of the market, maybe we could start a repricing for that jumbo hike.
I think, well, it's clear what happens is interest rates go up, particularly at the front end of the yield curve, and risk markets would be shocked by that, and you'd expect a decline in the stock market and a stronger dollar. But I think Christine makes an important point. I think for the Fed, the key thing is that they need to keep rates restrictive for some time to squeeze out inflation. So the other thing, perhaps with more detail, is what they do with the dot plot. And I'd expect their dot plot to be signaling, as they've already told us, but to really reinforce the message, then they're not anticipating a pivot in a quick reaction to a falling stock market, for example. So expect to see those dot plots reinforcing the idea that rates are going to be high for a prolonged period of time, and this means for more than the 6 months that are priced, but more like a year.
Miles, will we see the same actually then from the Bank of England and ECB?
The Bank of England is a bit more complicated, partly because obviously you've got a fiscal package that's going to be announced on Friday. But I think, again, if I was at the Bank of England, we know that we're going to get an easing of fiscal policy from the government, and that's going to be quite a substantial easing of fiscal policy. Rates are not in the right place. Again, the incentive, to my mind, is to get going faster towards that, call it neutral level, so that you're able to be restrictive in a more nimble rather than dramatic way by raising rates at 25 or 50 basis points as the incoming data comes in. So I would expect 75 basis points from the Bank of England on Thursday. But being a committee of 9 members, it's much more difficult to predict how individuals will actually vote and will have the majority.
Christine, what are you expecting for the Bank of England? I know there's been, traders pricing in 2 3/4 points of hikes by year end.
Absolutely, Francine. That's definitely the direction that investors want to push the Bank of England towards. But yeah, like Miles says, I think the Bank of England is in a bit of a unique, difficult position at the moment, just because, the inflation story is one side of the equation that they need to handle, but then they're also being confronted by a very real and very imminent cost of living crisis and an energy crisis heading into the winter time. I mean, if, they wanted to be cautious, 50 basis points seemed like the sensible way to go even just a couple of weeks ago. But after the ECB delivered their jumbo rate hike and potentially the Fed and the BOE is going to be coming after both of those central banks, the pressure is definitely going to be on for them to either follow suit or at least, if they go by 50 this time around, signal very clearly that they're open to more and bigger rate hikes down the line.
Thank you both for joining us. Christina Keener and Miles Bradshaw from JP Morgan Asset Management stays with us. Coming up, the Bank of Japan is set to become the world's last negative rate holdout despite record high inflation. That story is up next, and this is Bloomberg.
They have been less eager to really stimulate this time. That may be good for their economy and good for the long run, but it means for the world, you've got the #2 economy that's not really jumping forward. That puts more burden on the U.S. One way for the governments and the central banks to go is to focus more on production. How do you get more things out in the economy? And that makes it it means that you won't have to do as many rate hikes.
World Bank President David Malpass there giving his thoughts to Bloomberg on the inflation problem. Now, Japan's inflation has risen at the fastest pace in more than 3 decades, excluding tax hike distortions. That creates headaches for the central bank this week as it seeks to explain why it needs to continue with monetary stimulus. Well, still with us, Miles Bradshaw. He's head of global aggregate bonds at JP Morgan Asset Management. Miles, I don't know whether you want to call Japan the great experiment, or actually, I really don't know how they get out of this.
Yeah, and ultimately, the longer they keep policy neutral, or keep policy interest rates at where they are, the weaker the yen is going to be, and the greater the extent of imported inflation, and the greater the likelihood is that inflation expectations go up, which, let's face it, that's what they've been trying to achieve for 3 decades. So you could actually say that is actually a successful outcome. As an investor, though, I think the longer they keep policy where it is, the more likely it is that they actually abandon yield curve control. And so it's now is the time to be thinking about strategies that benefit from them abandoning yield curve control, knowing that actually it may not come at this meeting this week, but most likely I think you're going to start to see, whether it be leaks, whether it be conversations with analysts, discussion about how they actually abandon yield curve control, whether they move the target, which I think is less likely, or whether they actually start to bring the yield curve control target down the yield curve, and so gradually come off the market manipulation rates.
But Miles, so why have we not had it so far? I know we heard from Governor Kuroda that to a large extent he hasn't done much because he thinks any effort will be futile.
Yeah, because I think Japan is in a different place in terms of its inflation and particularly inflation expectations. I mean, let's face it, you've had the highest level of inflation, as you said, for about 3 decades, and it's coming with, less than 3% on core inflation. US core inflation is running at 6%. So I think the different inflation dynamics do justify the Bank of Japan to be the last out of the gates in terms of raising rates. And it is an economy where inflation expectations are for 0 or deflation, as opposed to the US and Europe, where they're around 2%, a bit above 2%. So they are in a different place. But ultimately, it doesn't seem that that's sustainable, that policy.
Right, and as you say, it's not sustainable given this economic backdrop. Do you see Governor Kuroda capitulating or at least changing only when we see, sustainable wage growth?
Yes, and his term is coming up next year, so it may be that he hands over and he can sort of say that he's actually achieved his objectives and someone else has to do the job of how do you actually return interest rates in Japan to a level that's set by the market. I wouldn't be surprised if actually he sees out his term by actually declaring victory over deflation.
Okay, so given the picture, we talked about BOE, we talked about the Fed, where do you see the main opportunity, Miles, in fixed income?
Well, I think we shouldn't forget valuations. Higher rates, that's the market creating value. As central banks who have been manipulating markets for decades in order to achieve, let's face it, quite justifiable, reasonable economic outcomes, as they withdraw from markets, it creates value. So I think investors shouldn't lose sight of that. Higher yields should bring more capital into the bond market. I don't think rates are yet at a level that you would call cheap. So I think for the time being, it's about positioning on the yield curve, being underweight the front end. It's about looking for relative value opportunities. In particular, we haven't talked about China, but the Chinese economy is in a different place. It's about looking at opportunities in emerging local markets where rates have already gone up and where bond yields are now arguably cheap. So relative value opportunities and keeping capital available to exploit any sell-off in markets and an overshoot in terms of valuation.
So you like China, and you've laid it out quite clearly. Like China, you like also emerging market local rates. This is despite recession risks or because of recession risks?
Because of recession risks. I think in places like China, the recession risks are elevated. The reopening could be a temporary short-term relief, but China's dealing with a housing market that is deleveraging, and best way out of that is to ease macro policy. Youth unemployment is at a very high level, so there is going to be a need to ease policy in China, whereas we're talking about the US and in Europe a need to be raising rates to create a recession. So very different markets there. And I think as a global bond investor, you want to be allocating your capital that diversifies your risk, so it gives you better returns over the longer term. And
Miles, I know you're looking at Mexico. What do you do with Brazil that has a whole other set of economic concerns?
Well, obviously the big issue in Brazil is the election coming up. But I think Brazil's in a similar position where rates have gone up sharply, growth is slowing, and that will bring down inflation with time. So you've got to, I think, be looking at it from that perspective. Same with Central and Eastern Europe, where rates have gone up a lot, growth is slowing. That's going to be more successful in terms of lowering inflation than perhaps you have in economies such as Japan we've discussed, which are behind the curve in terms of raising rates.
Miles, also Italy is going through elections on Sunday. It's quite incredible that actually the spread also between German Bunds and BTPs has not been wider. Is the market prepared for anything, or are they just hoping for the best?
I think the market is expecting the far right to take power, and the far right has come in saying they will abide by the EU fiscal rules. So the market is not so worried about election risks. We're not facing the prospect of Italy leaving the euro and a sort of breakdown of communications there. I think the challenges are going to emerge, as you were discussing, when they actually have to present their fiscal plans. So I think the risks are that as time goes, we see that Italy actually has more fiscal slippage than we expected from the previous government. but that will come from when they present their budget details.
Yeah,
and that will be obviously wider for spreads.
Yeah, and that of course depends on whether they stick to the reforms to get that tranche of money from the EU. Speaking of the EU, if you're the ECB right now and you're looking at these higher energy prices, is it one of the most difficult jobs in the world when it comes to central banks, or is it parallel to the challenges of the Bank of England?
I think it's parallel to the challenges of the Bank of England. It's how do you deal with stagflation? You know, you've got high inflation, whether it be energy prices, wages, and actually you've got a forecast, very weak forecast for growth. And you're not sure how your models work. Over the last 25, 30 years, growth has led inflation, but you're seeing inflation driven by a lack of supply rather than a excess of demand. So you're not clear to the extent you need a recession in order to slow inflation, coupled with the fact that the COVID reopening has seen a big bounce back in economies. It's not easy to extrapolate market trends and economic trends in terms of your models. So I think it's the issue of how do you deal with stagnation that is the key challenge really here.
Miles, thank you so much. As always, Miles Bradshaw there, Head of Global Aggregate Bonds at JP Morgan Asset Management. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Hong Kong's chief executive says he wants to relax the COVID measures that have made travel to and from the city difficult for nearly 3 years. John Lee says officials are actively studying new quarantine arrangements with a decision due soon. The South China Morning Post reports Hong Kongers to ditch hotel quarantine, swapping it for 7-day home monitoring. Now, Liz Truss says a trade deal between Britain and the US is unlikely in the short to medium term. The UK Prime Minister says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. The US is to release 10 million barrels of crude from its reserve ahead of the EU's ban on most Russian imports, which comes into force in December. It comes as global oil prices retreat to levels seen before Russia's invasion of Ukraine, and with OPEC discussing possible production cuts. Ukraine's foreign minister calling for more weapons from the West as it presses ahead with its counteroffensive against Russian forces. He told Bloomberg Ukraine wants to add to its recent territorial gains, denying Russia any strategic advantage.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
Separately, Liz Truss is reported to be planning to match this year's military aid to Ukraine in 2023. The UK Prime Minister will make the pledge to the UN General Assembly this week in her first foreign trip since taking over. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We are here, of course, in New York, following Liz Truss on her first trip abroad, amongst other things. Now, coming up, sustainability in the fashion industry. We hear from British Vogue's editor-in-chief, Edward Enninful. That's coming up next, and this is Bloomberg.
I mean, I remember a few years ago, I put Taylor Swift on the cover, and the byline was "Buy better, buy less," and it was a radical concept at the time. But now we all talk about sustainability. We know we can't keep shopping every day. We know we have to buy things that last, things that help the planet, things that we can pass on to sort of other generations. So I think that really is the conversation that the fashion industry is having right now that I find so exciting. And it's going to be sort of, people are going to have less money, so they have to buy things that last.
That is the British Vogue editor-in-chief, Edward Enninful, speaking to me. Of course, you can watch that full interview for our From the Ground Up series on Bloomberg UK website from 11 a.m. today. Now, we talk sustainability, diversity, and the future of fashion. In the meantime, the market's actually pushing higher. What we look at is that Fed jumbo hike being priced in. The dollar pretty much low changed after hitting a fresh record on Monday. Now, the U.S. Central Bank definitely kicks off its meeting today, but is expected to again hike rates by 75 basis points. notes tomorrow. We heard from Miles Bradshaw of JP Morgan Asset Management saying if they go for 100 basis points, it's not exactly priced in the markets. And so that means treasuries could be all over the place. Now, the long hold strategy is, of course, rooted in the idea that the central bank would avoid the disastrous stop-go policy of the 1970s that allowed inflation to get out of hand. So it's trying to front-run that inflation shock that we could get into the winter months. Coming up, Italy goes to the polls on Sunday. We'll discuss that next and look for market reaction. This is Bloomberg. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Here's what's coming up on today's program. Go big or go home. Global central banks line up jumbo hikes. The Riksbank surprises with a 100 basis point rate increase. The Fed begins its two-day meeting. Inflation headache. Japanese CPI hits a three-decade high, piling pressure on the BOJ to justify continued stimulus. Plus, relaxing restrictions. Hong Kong weighs loosening hotel quarantine rules, easing travel for the financial hub. So another story that could be potentially market moving. Italy goes to the polls this Sunday. A right-wing coalition led by Giorgia Meloni's Brothers of Italy will be hoping to make gains from the group of Enrico Letta's Democratic Party. We're joined now by Silvia Merler, head of Policy Research and ESG for Algebris. Silvia, thank you so much for joining us. I know you look at politics with a fine-tooth comb to also understand exactly what it means for the markets. The market, for the moment, is pretty sure that whoever comes in power next, and if you believe the polls, it's the centre-right coalition, that will stick to the fiscal rules, that will be able to have the money from the EU. Are you so certain?
Good morning. Thank you for having me. This is clearly an election that's going to be closely watched by the markets and in Brussels, most definitely, because it might be a defining moment for Italy on one end and European integration on the other end. We know that much of what has been done in the past 2 years at the European level is now going to find validation in Italy's success in pulling forward its national recovery plan. I think from what we have heard from the center-right, the direction of travel seems to be pretty clear, and it seems to be to abide to the commitment that have been taken. There are, however, some elements of uncertainty, one of which is the coalition has stated that they might want to renegotiate part of that commitment in light of the changed geopolitical environment. And while this is possible, and to some extent, some of the priorities might have changed, there's uncertainty as to whether this is going to take, how much time this is going to take, how long, and what changes in the reforms might be envisioned that are committed to in the plan.
But Silvia, if we've seen actually in the manifesto, right, that they want to increase spending. First of all, can Italy afford it? And what does it mean for bond yields?
So this is a question that we will only be able to answer when we see what the balance of power within the center-right coalition, which is poised to win, will be. Because if you look at the different proposals that come from the three different parties that are part of this coalition, and you take all of them at face value, if the coalition were to implement all of them, we would be talking about a deficit in the order of 2% of GDP. Obviously, fiscal space for Italy is limited by the fact that the country has a high public debt load, and by the fact that it's one of the countries that has been spending the most over the past 6 to 8 months to counter the effect of higher energy prices. Italy has spent already almost 3% of GDP on this matter in the past 8 months. So I think it is very unlikely that all the pledges in the government, in the center-right government coalition agreement would be implemented. And so what actually gets done and the size of the impact on the fiscal balance will depend on the internal balance of power of the different parties that compose the coalition.
And I imagine, Silvia, that will also, and something they've been talking about is, rewriting or amending, for example, the Recovery and Resilience Plan that Italy had set up to access the EU funds. Does this also depend on the weighting of each party?
The coalition seems to be pretty in agreement on that point. So I think that would probably be the line of the coalition, regardless of the balance of power. internally. Then when it comes to what potential redrafting may be looked for, then obviously, yes, that will also depend on whether we end up in a situation where the dominant party, which is likely to be Brothers of Italy, Giorgia Meloni's party, will have a significant gap, a significant advantage on the other members of the coalition. Now, on the rewriting on the plan, one thing I wanted to mention is some amendments might be even conceivable in light of the fact that the geopolitical situation has changed. And for example, if you look at money available under the Repower EU plan, which is the the plan that the EU has put forward to ensure national energy security in the context of the problems related to the war, the money that are on the table for that particular initiative are mostly coming from unspent or unrequested loans under Next Generation EU. Italy, being one of the countries that has already taken all its share of loans and grants under Next Generation EU, would therefore have very little money available extra for this particular spending type under Repower EU. So in that sense, some rewriting of the already submitted plan may make sense, but obviously timing is the big question there.
Silvia, talk to us a little bit about gas consumption. So it's unclear how friendly actually this new government will be with Russia's Putin. When you look at gas consumption, how difficult is it to reduce gas consumption, if I can get my words out, for Italians without putting them in too much pain, therefore losing the spirit that, you know, for the sanctions in Ukraine?
I think honestly, there's been on the, let's say, geopolitical orientation of this government, at least so far, Giorgia Meloni has been very clear that it would be in line with the European agreement, and so preserving the direction and preserving sanctions on Russia. The separate question of how Italy has been approaching the winter, I think it's also very interesting, and winter is going to be a moment of tension for countries in Europe, and in Italy maybe one of the countries where this is felt the most. Italy is in a lucky position because of the opportunities that it has to diversify supply, something that's not available to Germany, for example, and it has done so. So it has already significantly increased imports from southern gas producers, particularly Algeria. On the other end, and this is maybe related, potentially with, you know, like having higher imports, reducing the urgency of acting on the domestic gas consumption side, Italy has reduced gas consumption only marginally compared to, for example, Germany. We have seen a 15% reduction in Germany over the past 6 months, and we have only seen a 2% reduction in Italy over the same period.
Silvia.
So in a way, this I mean, this is a topic that must become central, I think, in the domestic political debate. The fact that we have elections so far into the autumn is likely to put pressure on the government when it is formed to deal with this.
Silvia, thank you so much for joining us today. Silvia Merler, their head of policy research and ESG for Algebris, joining us from Milan. Now, Ukraine again calling on Western governments for more weapons as it presses ahead with its counter-offensive against Russian forces. The foreign minister, Dmytro Kuleba, says Ukraine wants to add to its recent territorial gains and deny Russia any strategic advantage.
When you're fighting a war against such an enemy, you need more weapons. Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
And from the United States is already asking Congress for another $12 billion or so. The European allies have sent weapons. For how long are you going to be needing to ask for the increase of these supplies, the weapons and the ammunition?
Our recent successes in the east of Ukraine, I mean our counteroffensive, is an evidence that a combination of Ukrainian stamina and Western weapons, and most of them come from the United States, is the recipe to defeat Russia on the ground. So it's a clear message to everyone that it works, that it makes sense to help Ukraine with weapons, because we can defeat President Putin and his army in our territory. So, of course, the sustainability of supplies is an issue, and that's exactly what we are working on with our partners, not only in Washington, but also all across the globe.
You had this unexpected counteroffensive in the vast territories around Kharkiv. What's next?
Well, It was unexpected for some, but it was a thoroughly planned and well-thought military operation. The next phase will be to continue liberating our territories. We will continue our counteroffensive in the east of the country. I would like to recall that since 24th of February, the only region that Russia controls in full is this Lugansk region of Ukraine. Now, we have a clear goal of depriving Russia of this control, which will send a clear message that since 24th of February, Russia literally achieved no strategic gains in Ukraine.
I want to bring up the fact that what we're seeing in Europe right now, heading into a very tough winter. In Germany, in August, power prices, electricity forward power prices peaked in August, 1,050 euros per megawatt an hour. That is normally 40, 45 euros. Are you confident Europe is going to remain this resolve?
Well, the prices that you have just mentioned is the direct result of President Putin's energy blackmail of Europe and the entire world. And while he blackmails the West with high prices, he literally blackmails Ukrainians with blackouts. A week ago, Russian missiles hit a number of critical infrastructure elements of our electricity grid, causing blackouts in two big regions of Ukraine, including the Kharkiv region that was liberated by our army. Last night, a Russian missile hit near Ukrainian nuclear power plant. And that nuclear power plant also contributes to our electricity grid. So we're facing kind of different levels of problems with our European partners, but we work closely with them in order to sustain this pressure coming from Russia. And I see that European leadership is committed not to allow Putin to succeed, and we are working with them.
Ukraine's Foreign Minister Dmytro Kuleba there speaking to our very own Anne-Marie Herder. Now, coming up, opening to the world, Hong Kong is looking to relax COVID curbs and reconnect after 3 years of quarantines. We'll have that full story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Now, for nearly 3 years, travelers to Hong Kong have had to quarantine upon arrival, making plans to visit the island complicated. That looks like it's about to change. Now, for more on all of this, we're joined by Michelle Cortez in Hong Kong. Michelle, great to speak to you. So Hong Kong seems maybe a little bit closer, or closer than ever, to opening back up. What's the latest?
We are getting great news from Hong Kong today. It has been quite a long time in coming. At this point, what we're hearing is that the government is looking to cut quarantine out entirely when it comes to hotels. Until this point, travelers have had to go to a hotel either for as long as 3 weeks earlier in the pandemic, down to just as little as 3 days. That happened last month. And now we're hearing it's going to get to actually 0, which is great, because why would you want to go to a place and have to stay in a hotel for 3 days when you can't even leave your room? So hopefully that will open up. People will still need to track their own health for 7 days, perhaps not being able to go to restaurants or bars, some entertainment venues. The details are still a little bit unclear, but the idea that we're going to be able to get away from hotel quarantine is very exciting.
So, Michelle, I'm sure it is exciting after 3 or 2 very long years. How does the mainland feel about Li's plan to ease curbs?
We are hearing that Beijing at this point is looking favorably upon this approach. Certainly Hong Kong has suffered for the last 2.5, 3 years, and we see Singapore taking many of the activities, including many of the financial workers, people who are key to Hong Kong's success. So we do see a shift happening in China. We're not entirely sure what's happening there. China is still keeping COVID out entirely. COVID-0 is going hard in China, but not in Hong Kong. We're looking forward to changes, and we're not entirely sure when it's going to happen. We're looking for definitely by the end of October, hoping by the end of September.
Michelle, thanks so much. Michelle Cortez in Hong Kong for us. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Ford shares have tumbled in late trading after warning supply costs are running $1 billion above expectations in the current quarter. The U.S. car maker reaffirmed full-year earnings guidance, but signaled shortages of key parts will keep its inventory of half-completed vehicles elevated. American Express says it's planning to add 1,500 employees to its technology arm. The card company has told Bloomberg that roughly 60% of the hires will be over in the U.S., with about a third in India and the rest in Europe. Amex has already added over 3,600 tech workers this year as a surge in post-pandemic revenue allows for new investments. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, 6 years ago, a little-known textile maker called Shandong Ruyi Group embarked on a frantic acquisition spree with the ambition of becoming China's version of luxury powerhouse LVMH. Since then, its ambitions have quickly started to unravel. Well, the story of that unraveling is the subject of today's Bloomberg Big Take. Here to tell us more is our distressed debt reporter, Irene Garcia Perez. Irene, first of all, really congratulations on a wonderful story. It's a story that I follow luxury, and actually I didn't know much about this. So first, how did it all come crashing down for this company?
So the company blames it on the COVID crisis, on the Sino-US tensions, and tighter credit conditions. And while none of that helped, that's for sure, it also happened that a lot of these acquisitions were funded with debt. So as it failed to re-energize some of the brands it had bought, it became harder to fulfill those obligations both domestically and abroad.
So what's next for the group?
Well, the group is still negotiating with creditors, and because, of course, it's better to sell it at a higher valuation later on than just selling it at a discount now, or even worse, just losing it to creditors.
So, Irene, talk to us about, through your reporting, what was the most surprising thing about this company? Is it actually the brand recognition that maybe also it lacked, which helped or was partly due because of its huge descent very quickly?
So what was, from my end as a credit reporter, what was most interesting is some of the people involved mentioning how when they tried to engage with the company, it was very difficult to just get a reply from them. They were very keen while things were going well, but all of a sudden they just disappeared when things started to go wrong.
Irene, thanks so much. Irene Garcia Perez joining us today. And if you want to read the full piece, and I suggest everyone does because it's a little bit different, it's something that not many people knew about, just type NI Big Take and go on your terminal or log on to Bloomberg.com. Now, coming up, back to business in the UK, Queen Elizabeth's 10-day mourning period has come to an end. We look at what's on the government's agenda. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in New York. Of course, what we're doing in New York is following UN General Assembly. This is as all the heads of state from all over the world arrive. We'll follow a couple of them very closely, the ones that have elections soon. I'm thinking of Italy. I'm thinking, of course, of Brazil. And then there's Liz Truss. This is her first foreign trip as Prime Minister. She only started her job about 10 days ago. But then, of course, that was superseded by mourning for Queen Elizabeth II. Now, let's focus on the UK then. The country will begin to get back to business today after the funeral of the Queen and the 10-day mourning period. Markets open again after yesterday's break. Parliament will be back in session. Well, the Prime Minister, Liz Truss, has touched down here in New York for her debut as British Prime Minister. Bloomberg's Lizzie Burden now joins us with the very latest. And Lizzie, I know we have a reporter, of course, who was on the plane with Liz Truss, Kitty Donaldson, and she had quite a lot of breaking news in terms of trade and actually what Liz Truss wants to accomplish in her trip here in New York.
Indeed, and it looks like a US trade deal is not going to be negotiated in the near future. Liz Truss doing a little bit of expectation management there. That was something that was meant to be one of the biggest prizes in the crown of post-Brexit opportunity. But despite Truss being the former trade minister and the former foreign secretary, she is not seeing this as something that's likely. It didn't look likely under Donald Trump, let alone under Joe Biden, especially given her relationship relationship with him over Brexit, but it'd be interesting to see how their conversation goes this week. Also this week, though, on the domestic agenda, we're expecting a mini budget from the new Chancellor Kwasi Kwarteng, and he's expected to walk the walk on all of these tax cut pledges that Truss made during the leadership campaign, as well as to announce a 2.5% growth target. So really, this is the chance for Trussonomics to come into fruition.
Yeah, so if you look, and this is, as you say, a huge week for Liz Truss because of that mini budget by her Chancellor on Friday. But of course, she's also meeting with Emmanuel Macron. Maybe Biden will ask her some questions on the Northern Ireland Protocol. How big a week is it for Liz Truss?
Massive, premiership defining, really. She needs to set the tone policy-wise. She already managed to squeeze in, before the sad news of the Queen's passing, an energy bailout for consumers. Now she has the chance to follow it up with an energy bailout for business. And as well, we're expecting an announcement on how the government is going to deal with National Health Service backlogs, which of course perhaps are contributing to the inactivity rate, which is keeping the labour market tight. So all of this is Truss's opportunity to deal with the massive economic crisis facing the UK. The question is, though, how much will it add to borrowing and inflation itself, given how weak the pound is? We saw it hitting the lowest since 1985 last week on the anniversary, the 30th anniversary of Black Wednesday.
Yeah, a big deal, of course, when you look at sterling weakness. So what can we expect from the BOE this week?
Well, at the moment, it's between 50 and 75 basis points, it looks like. Earlier, we learned that markets are now seeing 3 75 basis point hikes by year end. There's a 60% chance, according to them, of a 75 basis point hike on Thursday, although that's down from 80%. Really, it's a question of the short-term inflation picture, given the help that the Truss energy bailout for consumers will give. Our economists at Bloomberg Economics reckon it will soften the blow to the extent that all we're going to see this week is a half-point hike. And I say all, that's compared to the Fed and the ECB. 50 basis points now looking somewhat dovish in the international context.
Yeah, there you go. Who would have thought? Hey, Lizzie, thank you so much. As Lizzie was saying, money markets pricing in 200 basis points actually of hikes over the next 3 decisions for the Bank of England. Our Lizzie Burden. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Anna Edwards in London. We look at markets for the moment. Stocks pushing higher in Europe. We'll see how futures open in the US. The stock 600 pushing higher as investors shifting positions ahead of a flurry of central bank decisions this week. That is, of course, led by the Federal Reserve. The US Central Bank kicks off its meeting today, but then is expected for the moment to again hike rates by 75 basis points on Wednesday. This is Bloomberg.
We're definitely seeing resilience in the U.S. economy.
Trying to sort of engineer the soft landing, I think, is a very delicate dance.
We still got to get to the next CPI print before you can have any sort of clarity at this point.
It's a great opportunity for the Fed to continue to raise interest rates.
I think quantitative tightening is going to keep a lid on the ability for bonds to really, really rally.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Central banks take centre stage. Sweden raises rates by a full percentage point. The Fed begins its 2-day meeting, and traders are betting the Bank of England will boost rates on Thursday by the most in more than 3 decades. Tale of 2 automakers. Ford declines after warning of the impact of inflation. Meanwhile, Porsche's record IPO is covered multiple times within hours. And Hong Kong wants to end COVID rules like mandatory hotel quarantines that have made travel difficult, of course, since 2020. China signals its approval. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, markets here in Europe a little sluggish. It seems to be in a sort of holding pattern, waiting for further central bank news. We've heard from the Riksbank, but of course the Fed, the real focus of this week.
Yeah, will they deliver a surprise like we got from the Swedish Central Bank this morning with a 100 basis point move, Anna? The move everyone is expecting is 75, but as we know, there is always room for surprises either way. Now, as for how markets shook out in the Asian session overnight after we saw that late rebound in U.S. equities yesterday. You saw some follow-through buying in the region. The MSCI Asia Pacific Index actually higher for the first day in 6, rising about 0.7%, and really the outperformance coming from Hong Kong on that story that Anna mentioned, that they are looking to ease up the quarantine, mandatory quarantine in the hotels for travelers there, easing COVID policy that has been in place for quite some time. And that, in theory, should be a big boost to the Hong Kong economy. So the Hang Seng Index up about 1.2%, and certain reopening sensitive stocks in particular, like Cathay Pacific, the airline, higher by about 2.2%. It actually hit its highest since June of 2020 in this session. And finally, in foreign exchange, I would just point out that for the 19th day in a row, we got a stronger than expected fixing bias from the PBOC for the Chinese yuan, really trying to shore up support for the currency. And yet it does not seem to be working, because once again, the yuan weaker against the U.S. dollar today, trading north of that 7 handle at 701.94, Matt.
All right, we'll continue to watch the currency story, of course, but I'm really focused in on rates. Here you can see, first off, futures down just about 0.1% after we had that turnaround in trade yesterday. We ended the day in the cash trade up about 0.7% across the board. But really, it's the rates picture that I think is important. You see these red arrows? No, they're pointed higher. They should be green. Right now, we see the U.S. 2-year yield continuing to climb 3.9686. I haven't talked to Bramo about it today, but I know she is on 4% watch for the 2-year. And then yesterday we saw the 10-year get over 350 for the first time since 2011. Right now we're at 352. So we see these rates climbing, but one, the smaller one, is climbing faster than the other, the bigger one, and that's why the inversion continues to grow. Finally, a look at Bitcoin. It's come back a little bit. Remember, yesterday we were trading under that $19,000 range for most of the session. Now we're at 19,316, so getting closer back to that $20,000 range, but really still stuck in the same space. Anna, what are you looking for in terms of European trade?
Well, I've got more on the rate story, just in keeping with what you were saying in a moment, Matt. But here's the equities picture for now. And we're seeing selling across equities. The London market coming back after being closed yesterday, so catching up a little bit. But elsewhere, we're down 0.5%, 0.4% on the CAC and the DAX. So selling across Europe. Our colleagues on the Markets Live blog saying we are at our cheapest for European stocks relative to US stocks when you look at forward PEs. Is being cheap enough, though, when you've got things like the gas crisis hanging over Europe? Speaking of that, let's check in with that gas price, because we have seen that gas price coming down in recent sessions. We're now down at 181, down by 0.2%. It was down a lot more than that earlier on in the European session, ever since last week when we heard from Ursula von der Leyen and what the plan was there to try and tackle the gas crisis. Add into that the money the Germans are putting aside to save, to spend on gas, and the deals they plan to do this weekend as they head to the Middle East. All of that in focus. Here's back to the rate story. We got a surprise this morning, as we said in our headlines, 100 basis points of tightening, a whole percentage point from the Riksbank in Sweden. Does that have any read across into other central banks? A question worth asking. And in terms of the market reaction, it was interesting to see what we got there, because the Swedish currency did gain initially. There was guidance that more hikes will come as well, but then it unwound the gain. It seemed that the central bank, at the same time as hiking rates, also adjusted where they expect the terminal rate to be. That came down. The market had already priced that in, and so it unwound the initial gains in the currency that we'd seen. The UK 2-year yield, in keeping with what Matt was saying about those 2-year yields, those short-term yields going higher, we're seeing that here in the UK as well. And as we said in our headlines, the market's increasingly pricing in a hawkish Bank of England this week and in November and maybe in December, where we get 75, 75, 50. The market's pricing in 200 basis points over those 3 meetings. Volkswagen in focus, up by 1.7% today. They have said that the Porsche IPO has got plenty of money behind it. Plenty of investors want to pile in, want to subscribe to this initial public offering. And it would be, Kailey, the largest. It will be, when it goes ahead, it'll be the largest in Europe for more than a decade.
All right, we're going to have more on that story in just a moment, Anna. First, though, let's get a look at what is ahead today. The United Nations General Assembly is kicking off here in New York, with leaders around the world descending on the city. So gear up for traffic this morning if you have to commute to work. Then the UK also getting back to business after the funeral of Queen Elizabeth II, with markets open and Parliament in session. Dock workers at the Port of Liverpool are set to begin a 2-week strike at the nation's 4th biggest gateway for global trade. Nobel laureate economist Joseph Stiglitz is among speakers at the Nordic Business Forum. And finally, on the economic data front, we'll get some here in the U.S., including building permits and housing starts, Matt.
All right, we'll definitely be on UN watch. at least for today. Let's take a look now back at Treasury yields. The 2-year yield's poised to crack 4% for the first time since 2007. The Fed's steepest tightening cycle in a generation, driving them higher. Bloomberg Christine Aquino joins us now to tell us what this really means, Christine. And we see also the yield curve inverting even further.
Absolutely, Matt. And I think, if we are going by where the terminal rate is for the Fed and whether the 2-year follows that, then it's going to have to go much higher from here, because at the moment, markets are pricing for that terminal rate to be at 4.5%. And we're still on 4% watch, as you mentioned, on the U.S. 2-year yield. And so it has a bit of a ways to go before it gets there. Of course, the question is what's going to take it there. And a lot of other things factoring into this as well, primarily where Fed officials themselves expect the terminal rate to be. The last update of the dot plot that we saw over the summer hasn't even factored in 4.5% yet. So let's see if that kind of all converges toward that terminal rate level. And as far as the inversion goes, again, this really just puts us back into even deeper inversion territory. Of course, we all know that that is less of a signal about upcoming recessions as it had been in the past. What I'm personally worried about is what happens when that curve starts steepening and when those longer term rates, the rates that really matter for the real economy, also start going the way of that shorter end move higher here.
Okay, so a lot of focus on the short end in the US, also in the UK, as we mentioned earlier. Christine, we'll get more on that in a moment. But let's think about what we heard from Sweden, because it's important for Sweden, but also because of maybe a precedent it sets, or at least the questions it raises about how aggressive, how hawkish central banks globally are this week.
Absolutely, Anna. I mean, if we go by what we saw from the Riksbank, from the Bank of Canada, a lot of these smaller central banks really are in quite a tough spot and feeling the pressure to deliver even more than what we've seen from the bigger central banks. And I think this is going to be the story. 100 basis point rate hikes, you wouldn't think of seeing that from a developed market central bank even just a couple of months ago. But this is the situation that they're in now. If they're a smaller open economy lever to these bigger economies, then they're going to have to do even more to outdo the Fed, the ECB, and all these other bigger central banks.
All right, Bloomberg's Christine Aquino, thank you so much. And speaking of other central banks, traders are rapidly dialing up rate hike wagers for the UK, betting the Bank of England will deliver 2 outsized increases by the end of the year. Bloomberg's Lizzie Burden is joining us now. So, Lizzie, 2 days to go. What can we expect from the BOE on Thursday?
Well, Kailey, it's between 50 and 75 basis points. As you say, markets are dialing up their bets. They now see 200 basis points of hikes in the next 3 meetings. In other words, 2 75 basis point hikes by year end. They see a 60% chance of 75 this week. But our economists say that the Truss energy bailout, which is going to cushion the blow of energy price hikes for consumers, actually means that the inflationary impact will be lessened, and so we'll only see a half-point hike. And most economists surveyed by Bloomberg actually agree with that. The other question, aside from the rate decision, is what the Bank of England does with active sales of gilts. They were meant to begin now, but given all of the borrowing that the Truss energy bailout and the tax cuts that we're expecting in the mini budget on Friday are going to entail, does that mean that the Bank of England needs to put the brakes on active quantitative tightening for now?
All right, Bloomberg's Lizzie Burden, great reporting as always. Thank you so much. Let's turn now to Asia. Hong Kong wants to relax COVID rules like mandatory hotel quarantines that have made travel difficult since 2020. That's according to the city's chief executive, John Lee. He spoke earlier.
While we will do our best to control the epidemic, we aim to have the maximum connection with the international world, and also to reduce the inconvenience to people who arrive at Hong Kong. That is a very clear goal, and that goal, I am maintaining it in one direction.
For more on this, we're joined by Bloomberg's Michelle Cortez in Hong Kong. So, Michelle, just walk us through what the policy in theory would switch to, and ultimately how much of a game changer this is for post-COVID Hong Kong.
What we're hearing at this point is that they're looking to entirely end the hotel quarantine. So that means this plan, which used to send people to a hotel for up to 3 weeks when they couldn't leave their room, now will have no time in a hotel. Instead, they can stay in their homes, just taking their temperature, perhaps testing to make sure they're not incubating the virus. There might be some restrictions on where they can go outside of their homes, whether it's limitations on restaurants and bars. But after 7 days, it's going to be free at last. And I tell you, there's a lot of excitement here in Hong Kong about this idea. It's really going to open up travel and make it possible for the city to reconnect with the rest of the world.
Yeah, I can tell you that it's pretty awesome to be in a country where the pandemic is over, at least according to President Biden. Michelle, thanks so much for joining us. Michelle Cortez there from Hong Kong. Let's get to the car maker news now. Volkswagen is paving the way for Europe's largest IPO in a decade. The automaker has published the securities prospectus for an IPO of its Porsche sports car unit. The books for the share sale are open now and have already been covered multiple times. Christoph Rauwald, our Frankfurt bureau chief, joins us for more. And Christoph, it looked like already they came out with a pretty easy valuation to hit 70 to 75 billion. There had been talk of, an 85 or 90 billion dollar valuation, and now this has been oversubscribed. Tell us about the demand.
Yeah, the demand seems to be very strong. I mean, the order books basically just like opened a couple of hours ago this morning here in Frankfurt, and basically, yeah, as you mentioned, the order book has already been oversubscribed basically, and yeah, I think we still have like a week to go. The first day of trading is planned for September 29th. So yeah, really off to a pretty strong start, and I think it does pay off probably that they didn't price it too aggressively as we discussed yesterday.
Off to a strong start then, Christoph. I mean, the significance of this is difficult to overstate, really, isn't it? The size of this IPO, when we finally see it, Christoph, it could be Europe's largest IPO in more than a decade.
And in an awful market.
Yes, I think. Yeah, in a totally awful market. I mean, Matt, we talked about it over the past few days and weeks, really. I mean, the market conditions could hardly be more difficult, probably. But it also goes to show that Porsche, as a company, has shown over the past few years that it can navigate any crisis scenario relatively well when compared to, like, direct peers.
All right, Bloomberg's Christoph Rauwald, thank you so much. And we'll have more on the Porsche IPO later this hour with Jefferies Global Autos Analyst Philippe Houchois. And we'll also be discussing Ford, because the automaker is the latest major company to warn about economic pressures weighing on operations. Ford is warning that inflation is pushing supply costs $1 billion higher than expected in the current quarter. It now expects adjusted EBIT in a range of $1.4 to $1.7 billion when it reports results next month, well below what it reported last year and a year ago. Ford also says shortages of key parts will keep its inventory of half-completed vehicles elevated. As for how that is impacting shares in pre-market trading this morning, they are down, and down rather hard, down about 5% before the bell. And again, we'll have more on this story in just a moment. It's a bit more positive story, though, when it comes to some of those stocks sensitive to the China reopening story, the one we were just discussing specifically with Hong Kong with Michelle Cortez, including U.S. casino operators that have big operations in Macau, the likes of Las Vegas Sands, higher by about 3%. And another big mover in early hours is Change Healthcare. This is after United Health won court approval for its $7.8 billion takeover of the company. The DOJ had been suing to block the deal, but no luck for them. And as a result, Change Healthcare up about 7% before the bell, Anna.
Yeah, Kailey, interesting to see that news out of Ford not weighing on European stocks today, not weighing on European auto parts companies. That's the best performing sector here in Europe. More, as you say, on the auto sector later. Coming up shortly, though, Sam Lynton-Brown joins us, BNP Paribas Global Head of Developed Market Strategy. Where does he see rates heading from here? A lot of focus on the short end as we head towards some really important central bank meetings this week. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. All eyes on the Fed, really a slew of central banks out, but the Fed, of course, the leader in this charge. And we are now pricing in a terminal rate of 4.5%. That's more than 100 basis points higher than the terminal rate we were pricing in before the last Fed meeting. So things move pretty quickly in the world of finance, and it's getting more and more difficult to raise debt. Joining us now is Priscilla Azevedo-Rocha, Bloomberg credit reporter, to talk about the effects, Priscilla, on companies. I mean, they're all coming to market, but the window is closing quickly, isn't it?
That is true. Matt, thank you very much for having me. So today we're seeing like this urgency to come to the markets. We have a lot of companies selling debt here in Europe, but we're seeing that this urgency is actually ahead of central banks, is that the window will eventually shut, right? The only way now we know that rates are going up, and those companies that need money, they need to tap the market.
So is this a global phenomenon then, Priscilla? I mean, clearly the Fed is in focus, as Matt said. We've got rates going up in other parts of the world, though. I mean, how is this impacting on bond sales here in Europe?
No, it's absolutely, Anna. This is a global phenomenon, but I think here in Europe in particular, the narrative is that this rush is here to stay, right? So we're seeing today in the market, we have everything. We have from sovereigns, we have banks, companies are rushing to the market to sell debt, and we saw that in the US last week as well. And this is like anticipating this hike path. All we know now is that rates are going up, right? So.
Well, in the UK as well, ahead of the BOE decision on Thursday, what's happening with sterling credit?
Well, the narrative is pretty much the same, right? This morning we saw a sell-off in government bonds ahead of the key BOE meeting. There's this sense among investors of caution. We have a cost of living crisis here. We have like expectations of what's going on Thursday. Also, there is a lot like investors are shifting position ahead of what's going on Friday, right? When the government will announce the energy crisis, the measures, and how much is it going to cost, and we're going to have more clarity over the shape of the measures to come.
Yeah, sort of mini budget expected in the UK on Friday. A fiscal event, they call it. Priscilla, thank you very much. Priscilla Azevedo-Rocha joining us there to talk about credit markets. And for more market analysis across all asset classes, MLIV Go is the function to use for the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Britain's new Prime Minister Liz Truss says a trade deal between the UK and the US is unlikely in the short to medium term. She says she will focus on alliances elsewhere. Truss spoke to reporters while flying to New York for the annual meeting of the UN General Assembly. President Biden's vow to defend Taiwan with U.S. forces if China invades is making a U.S. policy shift explicit. A spokeswoman says the president's comments on CBS's 60 Minutes did not mean that policy toward Taiwan had changed, but the remarks are being seen as a reversal of decades of so-called strategic ambiguity in which the U.S. refused to make its intentions clear. Hurricane Fiona has exposed Puerto Rico's fragile power grid. The storm caused a general blackout that affected the entire U.S. territory of 3.1 million people. The power outages hit just as Puerto Rico's Electric Power Authority is dealing with a bankruptcy that has no clear end in sight. And in Japan, inflation has accelerated to the fastest pace in more than 3 decades. That creates headaches for the Bank of Japan. It will try to explain why it needs to continue with monetary stimulus when inflation is above its 2% goal. Consumer prices, excluding fresh food, rose 2.8% in August from a year ago. And Matt, it's a question we've been asking a lot as you have global central banks, ex the BOJ, tightening policy in dramatic fashion. Kuroda is keeping things easy, keeping with yield curve control, and you've seen that borne out in the weakness for the Japanese yen.
Yeah, now they're looking at least a little bit of inflation, and that could help market forces that are already pressuring some increases there. So it'll be interesting to watch Japan. Anna, it seems like we've been watching every other central bank but.
Yeah, core inflation in Japan at 2.8% doesn't seem high by global standards, does it? But I can understand how it is significant in the Japanese context. More on bond markets in a moment. The US 10-year real yield rising to the highest since 2011 as we continue to focus on that higher yield environment. We'll get the thoughts of Sam Lynton-Brown, BNP Paribas Global Head of Developed Market Strategy. That conversation coming up shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Central banks take centre stage. Sweden raises rates by a full percentage point. The Fed begins its two-day meeting, and traders are betting that the Bank of England will boost rates on Thursday by the most in more than 3 decades. Tale of two automakers. Ford declines after warning of the impact of inflation. Meanwhile, Porsche's record IPO is covered multiple times within hours. And Hong Kong wants to end COVID rules like mandatory hotel quarantines that have made travel difficult since 2020. China signals its approval. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Matt was really taken by our colleague Michelle in Hong Kong earlier on, and I spoke to her a few times this morning. She did seem really pleased by that news, the freedom it gives you in Hong Kong if you're able to travel more freely. Talking about freedoms, let's think about where we are on the market conversation, because we're kind of in limbo. We seem stuck, a little tied, given what we're waiting for the Fed, waiting for that big central bank news.
Yeah, absolutely. I mean, that typically happens. And we did actually see a big move in the cash trade yesterday. The U.S. market jumped about 0.7% in the last hour of trading. We do have futures now that are back down about 1/3%, and you could see drops just depending on the hawkishness that we get. Is it even stronger than had been anticipated, as evidenced by the Riksbank coming out with a full 100 basis points? Taking a look at the 10-year yield, Kailey pointed this out to me. We've seen a jump in the 10-year yield to 117, almost 118 now, and this is something that Tom Keene and the the OG surveillance team is certainly going to be focused in on. What does that mean for financial conditions? Because they're still pretty loose, frankly. NYMEX crude is coming up just 10 cents a barrel to 85.82, but I only put it in there to indicate that it's not all about the dollar, right? We have some real assets moving higher, like oil, and some moving lower. Gold down to 1668, the lowest level that we've seen really since March or April of 2020 as the Fed continues to hike rates. Kailey, what do you see in terms of pre-market movers?
Well, there is a lot related to that move higher in the 10-year real yield adjusted for inflation, because we know that weighs heavily on stocks with higher multiples. So you're seeing a lot of those big tech stocks down hard in pre-market trading. But I actually wanted to focus on another group of stocks, and that would be the autos. After Ford yesterday, after the bell, warned on higher than expected supply costs, about $1 billion more than expected. So their adjusted EBIT's going to be lower than anticipated, both on a year-on-year basis and relative to the quarter they reported last go around. So that is dragging Ford down about 5% and taking peers down with it. GM is down by about 2.25%. It's a more positive story, though, for some of those stocks related to the Hong Kong reopening story that you and Anna were just discussing, the idea that you won't have to quarantine in a hotel when traveling to Hong Kong. And maybe that makes it a little bit easier to go to Macau and gamble. So as a result, some of those U.S. casino operators that have big business in Macau, Las Vegas Sands, and Wynn Resorts each higher 3% before the bell, Anna.
Kailey, really interesting. You mentioned what we're seeing in Ford and the wider auto sector. Interesting to me that that's not really spilling over into the European session. Auto stocks actually doing pretty well today. More on that in a second. This is the broad picture across the stocks Europe 600, then down by 0.4% today, giving up on those early gains we saw in European markets as we tried to play catch up with those late in the day gains on Wall Street that Matt referenced. Here's the Volkswagen share price up by 1.8%. This is in keeping with other stocks in the sector, though. It's not just VW going higher, although there is specific VW news around the intended IPO of Porsche. We'll get more analysis on this shortly, but we could see, of course, the biggest IPO in Europe in more than a decade, and it seems that it's well covered. There's plenty of demand for this IPO. That's what those who are raising this money are telling us this morning. Here we've got the Swedish krona against the euro. So here you've got the euro on the move here, and the Swedish krona actually giving up earlier gains. Those gains were triggered by a bigger than expected hike in interest rates from the Riksbank, 100 basis points, a whole 1% from the Riksbank. That was higher than the 75 basis points that had been expected. Does it set a trend? It didn't support the currency for very long, though, because of interesting things that the central bank said about rates, where they would peak out later in the cycle. And the UK 2-year yield, again, in keeping with that rally in short-end rates that we've seen, and a lot of the repricing of rate expectations globally. Well, the Bank of England is part of that story, part of that narrative. Will we get 75, 75 and 50 from the BOE? That increasingly seems to be the market's thinking, Kailey.
All right, Anna, well, let's continue getting thoughts from other markets guests as well. Joining us is Sam Lynton-Brown, BNP Paribas Global Head of Developed Market Strategy. Sam, as Anna alluded to, it's a big central bank week. We already had an upside surprise from the Riksbank this morning, a move of 100 basis points. What kind of surprises do you think we could see from the Fed tomorrow and the BOE on Thursday?
Good morning. Thanks for having me on. The market this week is really focused on the overall framework over what's the path through inflation, How does the labour market fit into that? In turn, then, how will central banks respond? And therefore, what's going to be the effect on the market? I think the Riksbank template will prove quite relevant for the Bank of England, where there's upside risks to what the market prices in. But in terms of market reaction to that, I think the currency will weaken if the central bank hikes by more. And this is because from the perspective of the foreign exchange market, front-loading rate hikes into a recession is not positive. It's tightening for the wrong reasons, and in turn, the currency impacts are likely to be positive. We saw this over the past few years in emerging markets. More rate hikes have typically corresponded with a weaker rather than a stronger currency, and I think that will provide an accurate template for the Bank of England. For the Fed, 100 basis points is a risk, but it's not our central case. We think it's unlikely. We think the Fed will deliver 75 basis points. More important for the market, though, I believe, is really going to be the data of the US. As I said, what's the path for inflation? Because we know that central banks are very data dependent. They're taking a meeting by meeting approach. The data is volatile. And in that respect, the forward guidance from central banks is less impactful than is typically the case. And what really matters here is US data.
That's really interesting, Sam, on the BOE, the idea that rate hikes could weaken the currency rather than making it stronger. I'll let Anna touch on that. I wanted to grab hold of the Fed and look at with you a chart that Valerie Teitel put together. She's one of our crack producers out of London. And check this out. The Fed continues to raise rates, but financial conditions just get looser and looser. Does this tell you that they're going to have to go further faster?
I don't think they'll go faster. That would imply a pace of more than 75 bips ahead of us, which is not what we expect. And I'd say the key point here is, from the Fed's perspective, they distinguish between the amount of tightening that's needed when rates are at zero versus the amount of tightening that's needed when rates have already reached what they might consider neutral or possibly even restrictive after the meeting this week. So the Fed are going to balance that message that the amount of tightening from here needs to be considered in the context of what's already been delivered and the lagged impact that will have on the economy. But also the Fed will need to be hawkish. Inflation surprised to the upside again. There's uncertainty over the degree to which core inflation is going to fall, even if headline does decelerate as the market prices in. And so the Fed will really need to deliver a hawkish message in line with recent Fed speakers.
As Matt was talking about earlier, Sam, fairly loose financial conditions when you look back over where they were at the start of the Fed hiking cycle, which might not be what the Fed wants to see. I talked to a colleague earlier about why that was, and he was flagging to me the fact that the VIX hasn't taken off and various other parts of the bond market have not seen spreads widening in the way that you might have anticipated with higher rates. Do we need to see some more sort of quote-unquote chaos before we get capitulation for markets and then can start to say, yes, we really have arrived and we really can look ahead to some sort of pivot?
It's interesting you bring up VIX, equity volatility in the US, and I think it's an important point because we'd actually argue that the fact that US equity volatility hasn't repriced higher makes some sense insofar as if the economy surprises on the upside, while that's good for us, the Fed will tighten by more. That therefore cuts the right-hand side tail of the positive distribution for equity returns. But equally on the downside, because the labor market is so strong in the US, because underlying economic momentum is decent, there's not a lot of downside there. So I'd argue that the failure of US equity vol to reprice higher is quite consistent with the macro backdrop we have. And the similar sort of calmness, relatively speaking, that we've had in US risk assets, we think is justified by the underlying macro backdrop and the Fed's reaction function to it. But as you say, for them, it doesn't help them because they're targeting tighter financial conditions. And with the strength in risky assets we've seen, that implies they might need to do more. And this is a key distinction with Europe. Whereas if there is a US recession, it's going to be highly likely policy induced as a result of the economy proving, if you like, too resilient, such that growth doesn't soften enough, so that the labor market doesn't weaken enough, so that core inflation doesn't come down enough. And that's quite a different situation to what we find in Europe, in Sweden, as we saw today with the Riksbank, what we're going to see later this week with the Bank of England, and also what we saw recently with the ECB, where the nature of the economic challenge is less policy induced and more the external shock. And that has very different market implications.
And just on those market implications, specifically here in the U.S., do you think the bottom is in already?
For equities, I think we're going to be in surprisingly narrow ranges, given how much uncertainty we're going to have in rates, on the basis of, as I said, the underlying backdrop caps the downside, the Fed's reaction function to that underlying backdrop caps the upside. I think for US rates, already we price a lot of volatility. So the level of front-end interest rate volatility in the US is super high, and we think that's actually fairly priced. It reflects that the backdrop is very uncertain. But if anything, we think that's where you might see some normalization in volatility markets first. Where we do think you can still have a further repricing higher in uncertainty is in foreign exchange markets, where volatility, although it's risen a lot, we think it can stay supported. And there's a number of exchange rates where we think it can reprice higher still. One of those is dollar Swiss, another is dollar yen. And outside of the US, we'd also suggest that investors focus on European volatility, especially euro cross vols in FX, which in our view don't correctly price how much idiosyncrasy there is to the European backdrop.
Sam, thanks so much. Thanks for joining us. Sam Lynton-Brown there from BNP Paribas. We'll get further analysis on the auto sector. We talked about this a couple of times already this morning, but really interesting to get some perspective from an analyst in the sector. It's one of Europe's largest listings in years. We will discuss the latest with the Porsche IPO next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with NATO Secretary General Jens Stoltenberg. That's at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards out of London. Let's look at Porsche right now. A monster IPO that has been multiple times oversubscribed within hours of the books being opened. At the same time, Ford says inflation is boosting costs by over $1 billion in just one quarter. Joining us now to talk about these two issues is Philippe Houchois, Global Autos Analyst at Jefferies. I guess we should start with Ford because that's going to have the most impact in the next few hours, Philippe. As the U.S. market opens up, Kailey has shown us the stock is already down 5% in the pre-market. What does this say about the global inflation picture, the supply chain snafus? It's not over, is it?
No, exactly. I think there was Ford did a better job in the last 2 quarters of fixing some of the heavier disruption that they suffered compared to some of their peers, but he's catching up with them. And if he's catching up with them, he's probably catching up with others. Some of the competitors like Stellantis are a bit more careful about easing supply chains. They can improve and right a bit. And of course, inflation is biting in a bigger way than car makers were willing to admit a few weeks ago.
So I guess the Fed raising rates isn't really going to help all that much. What do they need to do?
Well, I mean, the whole industry has to. The industry and the economy has enjoyed 10 plus years of falling cost of money, and more recently in the auto industry, this tightness of supply was very helpful, and then used car prices were doing extremely well, which actually makes new car prices more affordable, and all that is reversing, and so you basically. There's a bit of a Goldilocks situation during the restriction of COVID, and all this is normalizing. The positive still is that there seems to still be a shortage of cars, so we're not looking at a big decline in car sales from here, but the cost of buying a car and the inflation of materials going to the car are going to have to be compensated somehow or translate into lower profitability, which, to be fair, the market has started to price for some time already.
Philippe, good morning. So the market has started to price that for a while, has been pricing that in for a while. Are there some manufacturers then, I imagine there are, that are managing these challenges better than others?
Porsche, maybe?
Yes, whoever has more pricing power. So, Ferrari, Porsche, those businesses have a bigger backlog of vehicles. Also, in some cases, my understanding when you buy a Ferrari and the delivery is going to be 12 months later, where the price is not completely set. The price needs to be adjusted as you get closer to the delivery. So those car makers have ways of adjusting that maybe more volume car makers do not. And then if inventories do come back at dealer levels, then dealers will set more of the price than what we've been able to experience during COVID. And that is also going to be another variable in the pricing environment for the car makers.
Well, Philippe, clearly Matt really wants to talk about Porsche, so let's talk about it. What do you think of the 75 million euro valuation and how ultimately the public market is going to receive this IPO?
Yeah, well, I think the noise around this IPO has been relatively transparent. The press was quite active in giving us ranges of 60 to 85. No surprise, this range now is narrower and comes back towards the middle of that range. Now, we've been on the road a lot talking to investors about this IPO, and clearly there's a lot of interest in it. So I would say, we have to keep in mind this IPO is unusual in the sense that it is aimed to reach a balance between a decent price for the seller, Volkswagen, and a manageable price for one of the buyers, Porsche SE. So it's not a traditional book build where you might expect upward pressure on the price, because this is a fully formed business with a very strong track record. So this business, this IPO is coming at a level which seems maybe a bit lower than what the underlying interest or demand that I'm hearing from investors when I speak to them. And I've been speaking to them for the past several weeks.
Well, some investors are, giant institutions that are already set and buying big chunks. Others are probably retail investors who just want to put their certificate up on the wall. What do you think of the valuation of Porsche in terms of, price to sales compared to your typical automakers, your big volume manufacturers, and then also compared to like Ferrari and Tesla?
Yeah, of course. No, it is a different animal than car makers, but it is not Ferrari at all either. And if we look at the valuation that is implied in this range against our numbers, looking at 15 times earnings, maybe 13 times EBIT, those are pretty much half the multiples of Ferrari. But the returns on capital of Porsche also half those of Ferrari. So there's logic in there. And then discussions with investors, of course, was you could argue Ferrari is a beautiful business in terms of returns. It also has a solid governance and very good liquidity. And the last 2 points are still question mark around the IPO of Porsche. So that's going to be, but of course, for Porsche management, Ferrari is going to be the benchmark, and they will have to see how they get close to that benchmark. Against the rest of the industry, and of course, post-COVID, car makers are pitching to investors that they are going to be better car companies going forward, less volatile in earnings, higher returns. But of course, the market wants to validate that first. And Porsche has shown for years that they were delivering very strong margins, good cash conversion. So that volatility that impairs the valuation of car makers doesn't really burden the valuation of Porsche.
Philippe, you've told us the very sensible story. There's more to these companies than just a ticker name. But I know Ferrari is race. Do we know what Porsche might be?
I'm not quite sure. I think I heard something, but they've tried something funny in the same way that they've chosen to have 911 million shares. So there is definitely a sense of humor in Stuttgart.
Excellent. That's what we look for. Thank you very much, Philippe. Thanks for the analysis. Philippe Houchois, Global Auto Analyst at Jefferies. Thanks for your insights. Now, world leaders are descending on New York, as Kailey was saying, for the United Nations General Assembly. We'll get further updates on what to watch for there shortly. This is Bloomberg.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
That was Ukraine's Foreign Minister Dmytro Kuleba speaking with Bloomberg's Anne-Marie Hordern at the United Nations. Which brings me to what I'm watching today, Matt and Anna. The United Nations General Assembly begins today. It runs through September 26th. Obviously, the war in Ukraine is going to be very high on the agenda. But more importantly for New Yorkers like me and Matt, it's going to mean more traffic in the city. So give yourself a little extra time to commute this morning if you haven't already factored that into your plans, and just keep in mind that it's going to take you a little while longer to get around the city, especially on the east side with that going on down by the water, Matt.
Yeah, I would like everyone else to take public transportation.
But not you?
That would be the, I can't. I like to have my own stereo system and everything.
Of course.
I'm watching the 4-day work week. This is something that I think most people consider a joke. I can't wait to share it with my radio co-host, Paul Sweeney, a little bit later. He's already angry that people phone it in so much these days. But actually, there is a pilot program being tested out across across 180 companies over 6 months. The UK results have come in. Now, 78% that participated in this pilot program said the transition to a 4-day work week was good or seamless. 86% are going to keep to this schedule. So they'll continue having just a 4-day work week, just 32 hours a week, basically, for employees, but pay stays the same. And the key part is productivity stays the same. For almost all of these companies, 95% said productivity stayed or actually improved. You had 49% that say they boosted productivity with this because workers were happier and willing to do or able to do a better job. And I just think it's really a fascinating idea. Why not have a 3-day weekend?
Matt, sounds like you need to move back to Europe with this in mind. I remember I spoke to the organizer of this. She's from New Zealand, and they tried it on their business, and it seems to be doing well. Anyway, excellent, really interesting story. No such thing as a 4-day week if you work for the UK government, though, right now. You need to get back to work, back to business. We've got energy news to come later on this week. We've got a fiscal event taking place on Friday. The Chancellor there, what will he be giving us in terms of taxes? He's already there's been a firing of a Treasury official over recent days, so it's been a busy time already. Financial services regulation could be in focus, and we hear from the Bank of England, of course, on Thursday. So lots to talk about when it comes to the UK and its economy. That is it for the early edition. More surveillance is ahead. They will be hearing from Anna Han of Wells Fargo. Lots more conversations still to come. This is Bloomberg.